This video is going to be for new traders that have very little knowledge of Forex or are complete beginners to trading. This is going to be your one-stop shop to get the basics of Forex trading. So this video is going to be split into 4 separate parts. Firstly, we're going to cover what software you need if you want to start Forex trading. Secondly, how people make money in the Forex market. Thirdly, we're going to go over the basics of the market, which will include things like market structure, an explanation of candlesticks, trading sessions, and supply and demand. And lastly, we're going to be going over what a trading strategy should provide you. So first, we need to go to tradingview.com and make a free account if you don't already have one. So you would just click up here in the Get Started section and then just click Sign Up. TradingView is a very commonly used charting software. This is where you can get all the data you'll need in order to do your technical analysis. Technical analysis is the way that traders make sense of what they're seeing while on the charts. The other software that we're going to need is MetaTrader 4 or MetaTrader 5. Personally, I use MetaTrader 5, but I still know plenty of traders that use MetaTrader 4. You'll be able to download MetaTrader 5 from its website, which is metatrader5.com. Also, whenever you choose a broker, they should have an option for you to be able to download a MetaTrader platform from their site. So you'll use MetaTrader to take trades, look at charts, and to modify your positions. If you're unaware what brokers are, they're basically your connection to the market. You put funds into a brokerage and that brokerage allows you to place trades within the market. I don't have a broker to recommend, but I would say to do your own research and pick wisely if you're putting your funds into a broker. Brokers typically have something called a demo account. These accounts allow you to take trades without using any real money. Demo trading allows you to practice your strategy and to get a feel for how your broker functions. And for the newbies, it allows you to get accustomed with the MetaTrader platform. TradingView is typically the preferred software for market analysis since it overall just has a nicer aesthetic and it's more updated than MetaTrader. But if you prefer to do all your analysis on MetaTrader, feel free to do so. Now for part 2. How can you make money in the Forex market? This is the absolute simplest way that I can explain it that requires you to have no previous knowledge about Forex. So the price of something can either go up or it can go down. And if the price goes in the same direction of our trade, we make money. And the amount of money made is dependent upon 2 factors, which include what is the lot size on that specific trade and how many pips did that trade run for. Lot sizes are pretty simple to understand. In the description below, I have a lot size calculator that you can mess around with to get a better understanding of how they work, but I will provide you with a very quick and simple overview. Lot sizes refer to the amount being made or lost per pip of whatever instrument you're trading. Before we continue, we need to know what a pip is first. A pip is the smallest unit of a price move. So if the price moves in your favor by 1 pip, you make money. And if it moves against you, then you would lose money. A pretty basic understanding would be this. Here are 4 different lot size. And here the smallest lot size we have is a 0.01, which means per pip, this is going to give us 10 cents. So if we were to make 10 pips on a 0.01 lot size, that would make us $1. And then for this lot size, this 0.10 lot size, the amount per pip is $1. So 10 pips with this lot size would give us $10. And then this lot size right here is 1.00. When you have a number over here on the left hand side of the decimal place, this is called a standard. This 1.00 lot size would give us $10 a pip. So if we say that we made 10 pips, that means that this would be $100 made. And then we have 10 standards here. 10 pips at this size would make us $1,000. It's a pretty simple concept and doesn't take too long to grasp. This is why you need to be aware of the lot size that you're trading, because it determines how much you can gain or lose per pip. TradingView has multiple ways to measure pips, whether it's holding shift and left clicking to get this little measure box that shows the pip count right here to the right, or if it's a position tool like this one here, which you can find on this toolbar here next to long position and short position. This would be for buys, and then this one here would be for sells. And then we can see the pip amount that says 329.7 pips, which if we measure with our shift left click, it measures to be the same amount. So TradingView has multiple ways to measure pips. I would keep it in the back of your head for now because you're gonna need some space in there for what I'm about to teach you next. So now we're gonna be going over the basics of market structure. So price can move in one of three ways. It can either go up, it can either go down, or it can move sideways. When the market is moving up, that means that the market is bullish. And then when the market is going down, that means that the market is bearish. When we're in a bullish market, we're creating higher highs and higher lows. In a little bit, I'll show you what that means. And then inversely, with a bearish market, we're creating lower lows and lower highs. And then lastly, we can have a consolidating market, which is this sideways movement that occurs when price doesn't really have a true direction just yet. For this bullish trend right here, I'm gonna mark the points that either represent a higher high or a higher low, so you get a good grasp of this. So first we have this higher high right here because this area is higher than this previous area, and it's a high for price. Then we have this pullback that occurs. This is a low, but it's a higher low, and this is because price did not go all the way back down to this previous low. And then what happens after that? We have a new higher high. This high is up above this previous higher high, so this becomes a new higher high. And then here we have this higher low because it is higher than this previous low right here. So then that's marked off. And then this would be the higher high created. And that's the highest high that occurs. Next, let's mark up this bearish trend. Since we have this downtrend, I'll point out the lower lows and the lower highs that are created. So here we have our first lower low. Then we have a lower high right here. Another lower low created, and then a lower high. So this is a lower high because it is lower than this previous high that was created, and then this is a lower low because it is lower than this previous low that was created. And then finally at the end we have this lower low. So unlike bullish and bearish market structure, consolidating market structure won't really have any higher highs or lower lows. They'll really just either be highs or lows, since they're not really getting higher above a previous high or lower below a previous low. So that's why this would be a low, this would be a low, this would be a low, and then these would be highs all up here. Since they're not really going past the previous high, they're not a higher high, they're just a regular high. Now that we have an understanding of the three different types of market trends that can occur, let's go over what a candlestick is. Candlesticks are going to be your way of reading the data that the market presents. So a candlestick has a high, a low, an open, and a close. These are the four parts that make up a candlestick. And these parts are measured within a certain time period. So you can have the daily candlestick, which measures all the data that happened within a day. You can have the 5-minute candlestick, which measures all the data that occurred within 5 minutes. And when I'm saying data, I'm referring to the price fluctuation that occurred within that time period. Knowing about candlesticks is a great way to help you understand the market movements and make better trading decisions. Let's go over these two candlesticks that I've drawn out. So as we see here, this green candle has a close that is higher than its open. So let's say this candle is measuring an hour's length of time. Let's say it's measuring 9 a.m. to 10 a.m. 9 a.m. would be the open down here, and then 10 a.m. would be the close up here. And since the close is higher than the open, that would mean by the time that this candle closed, price went up. However, on this red candle, we see that the close is actually lower than what the open is. So this candle actually shows price going down. These two thin lines that go out from the candle body are what we call wicks. And wicks show how far price moved within the time that that candlestick was actually being made. So let's think of this as also a 1 hour candle from 9 a.m. to 10 a.m. So 9 a.m. opens up and price is right here, right at the open. And then let's say by 9:15, it looked like price was going up. So then this area was created. But by 9:30, price was all the way down here, meaning that there was a wick left here. Price was no longer at this area, so a wick was left there. And then by 10 a.m., by the close, price was not at this point anymore. It actually moved up a little bit. But being that the close is lower than the open, this would be a red candle or also a bear candle. And then this is a bullish candle. Since it's going up, bearish candles are going down. Now that you have a bare bones basic understanding of the market and candlesticks, let's get a chart pulled up so we can see what all this actually looks like. So I have Euro USD pulled up and I am on the daily chart. That means that each one of these candlesticks actually represents a day's worth of price movement. And then we can go down to the 4-hour time frame by clicking this button up here. And you guessed it, each one of these candles represents 4 hours of price movement. And we can get lower and lower to see a more detailed tale of events. So you might be wondering, why is this the Euro USD chart? Why isn't it just the Euro or the US dollar? Well, the reason is because this chart is measuring the exchange of value between the two currencies. So since Euro is in the front, if this chart is going up, that would typically mean that the Euro is strong. And inversely, if price is going down, that would typically mean that the US dollar is strong. Now, if you were paying attention, you would notice that I said it would typically mean. This is because price going down could actually mean that the Euro is just really weak at the moment and have nothing to do with US dollar strength. And then vice versa for price going up. The next thing to consider would be the time that these candles are printed. Some candles are much larger compared to the others, and this is typically due to two things. One could be maybe some news came out and it affected the currency's value, so we see it heavily represented here on the chart. Or two, it was during a high volume trading session. Forex has 3 main trading sessions: the New York session, the Tokyo session, and the London session. This graph here depicts the time of these sessions. And you might be wondering,
okay, and why should I even care about New York or London or Tokyo session or whatever?
The answer is simple. A Forex pair that has the US dollar in it is going to move a lot more during the New York session, due to it being connected to the United States. And this is relevant to all pairs. For example, the Great British Pound against the Japanese Yen is going to move a lot during the London session since it has the Great British Pound associated with it. The London session and the New York session is where you're going to see the most volume, aka the most activity within the market. So if you're deciding on which pair you want to study, make sure to take the correlated trading session into account. The last part of this section is very important, so make sure to pay attention. We're going to be going over supply and demand. These two things are what move the market. And the concept is simple. When something is in high supply, that would indicate that the value is likely to depreciate. So what then follows is price goes down. And then on the other hand, when something is in high demand, that means that its value is likely to appreciate. It's likely to go up since it's in demand. Here I've drawn out a visual example to use. At the top here we have supply, and then at the bottom we have demand. But you also see here in the middle we have supply and demand. This is because these supply and demand levels can act as either or. Now I get it, I'm sure that sounds confusing, but I assure you it's not. Let me show you what I mean. I'm going to highlight the areas where price was at supply and where it was at demand, so you have a better grasp of the concept. So I have my little supply bubble and my little demand bubble. So we see here, price was at demand. Then here we have price at supply. Since there was a good supply there and demand was not strong, price came down, came back up. And once it came back up, since there was a good supply, price came back down. But then there was enough demand at this level where price pushed up, came back down. Here we have demand. Since price hit this area, came up. Here we have price at supply, so we're going to mark that with the supply bubble. Price came back down to the supply and demand zone and acted as demand, so price went up, broke through this zone, came back up, This area was acting as supply for price in both these zones. And then lastly, we had price come back to demand. It went up for a little bit, came back down, price acted as demand again. Now, I know I went through that pretty quickly. It might seem a bit confusing at first, but I suggest that you practice this or review this session over again, but it's fairly simple. If demand is strong in an area, price is going to move up, and then if supply is strong in an area, price is going to move down. So the fact that price reached this area twice and came back down means that supply was strong. This third time where price was in this supply zone and it didn't come back down, that means that the demand was actually stronger. So then once price came back up here, came back down to this zone, price went up again. That's because the demand at that price was there. I know it can be a bit tricky at first, so just make sure to practice and watch this over a couple times. And now for part 4, we're going to be going over what a trading strategy should provide you. A trading strategy is what will give you your edge in the market, and it will provide you with a plan to execute for each of your trades. Your strategy will provide insight and exposure of a repeated behavior in the market that gives you a higher probability of being able to profit off the potential next move that may or may not occur. It's good to find a strategy that makes sense for you and your lifestyle and to stick with it. Hopping from strategy to strategy is a recipe for disaster. And you might be thinking,
Well, I want to learn the best strategy.
I'll let you in on a little secret. There is one strategy that is the best, and it's the one that you can follow and replicate over and over again. So make sure to give a strategy a fighting chance and see what damage you can do with it. Refining a strategy takes time and experience, and as a beginner, it would be within your best interest to find someone who can educate you and help you with the strategy. This will shorten your learning curve immensely, but ultimately, it's up to you. You can walk this journey alone, but I can't stress it enough. This option is significantly harder. The market repeats itself over and over again. A strategy takes that repeated behavior and breaks it down into a couple key points that need to occur. When these things occur in the market, that presents the trader with an opportunity to execute a trade. Real traders don't just get into a trade because they want to feel involved. We only get into trades when it makes sense for us to do so. This is how we can reach consistent profitability. It takes no real skill to make money on a trade. Seriously, think about it. You press the money and boom, you made money. Cool. But can you do it over and over again? The answer is a strong no. You need a strategy that provides you with an edge in the market that will allow you to use a system to have a higher probability of winning your trades. Now, I know it might feel like you're drinking water through a fire hose. I remember that's how I felt when I first started learning about Forex. So if you need to go back to some parts of the video to get a better grasp of everything, by all means, do whatever is going to help you. I know this can seem like a lot, and YouTube is piled with tons of trading content that can either be useful or just absolutely catastrophic to your growth. So for those of you that have stayed to the end of the video, I have a free resource that will help you with the basics of trading. In the description, I have a link to my Telegram and my Discord. Join either one of them and comment the word serious when you're on the platform, and I will send you a link that will help you further your knowledge completely for free. I also post chart markups and breakdowns in my Telegram and Discord that will help you see the way that I trade. For those of you that are really looking to make side income or maybe even leave your job, I wish you the best on your trading journey. It's not an easy journey, but it is definitely one worth giving your all. If you enjoyed this video, hit that like button and consider subscribing. I have 2 videos at the end for you. One is going to show you how I practice my trading strategy, and the other will be my top 3 psychology tips for beginning traders. And until next time, guys, I'm out.